Welcome to the Tepper School of Business Multimedia Series. For more information on the Tepper School at Carnegie Mellon, please visit us at www.tepper.cmu.edu/multimedia. And now, here's your selected video.
Good afternoon to everyone and welcome today. My name is Bob Damon. I'm the Dean of the Tepper School of Business at Carnegie Mellon University. Today it's my great pleasure to have the opportunity to introduce our WL Mellon CEO speaker, Dr. Roger Ferguson. As many of the Tepper students who are here know, the WL Mellon Speaker Series is an opportunity for our students to hear from some of the country's most respected and accomplished CEOs. It sort of adds a significant amount to the educational experience that we give our students here at Carnegie Mellon. So I want to welcome you here, and I want to welcome Dr. Ferguson as well. Roger is President and CEO of TIAA-CREF. TIAA-CREF is nearly 100 years old, founded in 1918, and has in common its founder with Carnegie Mellon, Andrew Carnegie. Roger is the former Vice Chairman of the Board of Governors of the U.S. Federal Reserve System, and in one of Roger's finest moments at the Board of Governors, he was the only governor in Washington, D.C. on 9/11/2001, and he really led the Fed's initial response to the terrorist attack. And his actions have been credited with keeping the U.S. financial system functioning during that crisis and reassuring the entire global financial community that the U.S. economy was not going to be paralyzed by that crisis. After leaving the Fed, Roger served as head of financial services for Swiss Re and chairman of Swiss Re America Holding Corporation. He joined TIAA-CREF in 2008, guiding the company successfully through the most recent financial crisis and also into a period of growth and diversification for TIAA-CREF. Today, TIAA-CREF has more than $500 billion in assets under management, more than 4 million individual clients, and more than 15,000 institutional clients across higher education and the broader nonprofit community. Roger is currently a fellow of the American Academy of Arts and Sciences and a member of its Commission on the Humanities and Social Sciences. He is co-chair of the Committee on Economic Development and vice chair of the Business Higher Education Forum. Roger served as co-chair of the National Academy of Sciences Committee on the long-run macroeconomic effects of the aging U.S. population, and as a member of President Obama's Council on Jobs and Competitiveness. Roger has a bachelor's and a PhD in economics, as well as a law degree, all from Harvard University. And I promised him we would still be nice to him today. So please join me in welcoming Dr. Roger Ferguson to Carnegie Mellon University.
Thank you. Great. Thank you very, very much for that kind introduction, and thank you for that warm welcome. It's a pleasure for me to be here at Carnegie Mellon. You've heard already about the great history our two institutions have in common. I'm going to elaborate on that a little bit by talking about my actual personal link to Carnegie Mellon, which goes back quite a ways. When I was at the Fed, I was often invited to come to the Tepper School by all of your faculty members who are interested in financial matters. And now at the Tepper School, one of my good friends, Marvin Goodfriend, is a faculty member here as well. Chester Spatz is a person I've known for a long time. And so the links between TIAA-CREF and Carnegie Mellon run through not just Andrew Carnegie, but Alan Meltzer, Chester Spatz, Marvin Goodfriend, and Roger Ferguson. So it's really a pleasure for me to be here. This is a seminar or a discussion group that I know is very focused in issues of public policy and financial matters. And my talk today will be focused on one of the big challenges of the day, which is around retirement and retirement security. And what I hope to do is to provide you for some food for thought that you as young individuals and future business leaders, not just here in the U.S., but globally, can take away. And I also look forward to a robust Q&A session. So let's begin by taking a look at the issue that has tremendous implications to all of us in both the public and the private sector. And as I said, that's the retirement situation here in the U.S. That has been described as, quote, the greatest retirement crisis in American history. In fact, some observers have said that for the first time since the New Deal, the majority of Americans are headed to a retirement in which they will be worse off, not better, but worse off than their parents. And the reason ultimately is the huge deficit that this country faces in retirement savings. There's a Senate report, I think, from last year that calculated that we have a retirement deficit of as much as $6.6 trillion, or about $57,000 for every household in America. So against that backdrop, it wouldn't surprise you, it doesn't surprise me that Americans' confidence about having a comfortable retirement has hit record lows. Obviously, the financial crisis was one of the factors that has led to that decline in confidence. But there's actually a bigger effect that I'd like to focus in on, and that's the long-term factors that have occurred in American society for many, many years. One has been the shift from traditional pensions to 401ks in the private sector, and with that has come a big shift in responsibility for funding retirement from employers, from companies to employees. What's been happening with the shift from traditional pensions to 401ks is that workers are being called upon to make savings and investment decisions in a way that will generate enough income to fund long retirements. So an obvious question is, how are we doing with that shift? How is the average American doing taking on that responsibility? The sad news is that the statistics are not very encouraging. Today, more than half of workers say they and their spouses, believe it or not, have less than $25,000 in total savings and investments. 28% have less than $1,000 in total savings and investments. And only 57% of workers say they are currently saving for retirement. So because you are focused in on statistics, you'll say, well, that's very interesting, but that may not really talk about the group that really matters, which is those who are getting closer to retirement. So even among people who are approaching retirement, the most recent national data show that the median combined 401k and IRA balance is somewhere around $120,000 per household. Now, that data is from a few years ago. Markets had until recently been rallying, so that number has probably gone up some. But whatever happens, one would certainly have to say that $120,000 for the median is probably not sufficient to deal with having a safe and secure retirement. So that's the snapshot from the private sector. The picture is frankly no better in the public sector. All of you know that the public sector is facing unprecedented challenges about its pension promises and keeping those promises to workers. Unfunded liabilities for state and local pension systems are estimated to be, believe it or not, almost $1 trillion. Headlines are abound. Detroit, Chicago are clearly in the headlines. A number of states are struggling with how to deliver on the promises that they've made to their workers. So for all workers, both in the public and the private sector, there are some challenges. I had an early discussion today with the Dean Krishnan here, and we added to the discussion around retirement questions around health care. Healthcare costs are clearly threatening the long-term viability of even the nest eggs that we have all built up, even for the best funded. So it's clear that future retirees, all of us, have reasons to worry. And I know this is lunch, so at some point this will turn uplifting, but right now I'm going to keep giving you some facts. So the other reasons that folks are worried, obviously, is something that all of you know, which is many people, particularly younger folks, are not sure that they're going to be able to count on Social Security, Medicare, Medicaid to the same degree of previous generations. No news here, but those programs are also under great pressure due to aging populations here in the U.S., which is the major demographic trend that's driving much of the discussion around retirement policy. So let me turn a little bit to what we know about the aging population in the U.S. Last year, as I think you heard in the introduction, Ronald Lee, who is a demographer and economist from University of California at Berkeley, and I co-chaired a National Academy of Sciences committee on the macroeconomic impact of the aging population. And the first fact that we noted is that the aging population in the U.S. is due to two trends. We often talk about one, which is the rising average life expectancy of all of us baby boomers and all of us in society in general. But the second factor is the decline in fertility rates, and I'll come back and talk about that. Another big finding, and I see in this room quite a diverse crowd, this issue around aging that I'm talking about is not just an American story, it's a global story. By the mid-century of this century, many developing nations will catch up to the developed world in terms of what's called the old age dependency ratio, the number of elderly people as a share of working age population. So globally, the upshot is that there are going to be fewer and fewer people working, and we will be supporting more and more people who are retired and not working, which is a recipe for a big fiscal challenge here in the U.S., but globally. In the U.S., we've already seen some of the strains, as I've said, around Social Security, Medicare, and Medicaid, but those strains likely get worse in the years to come if we do nothing. Today, only about 12% of the population is age 65 or older, which is to say eligible for Medicare. But by 2080, it will go from being 12% of the population to 23% of us who are eligible for Medicare. At the same time, the working age population is going to shrink from about 60% today to a projected 54% in 2080. And so Social Security here in the U.S. is going to experience a decline in what's called the worker to beneficiary ratio. It was 3.3 in 2005, 3.3 workers for every beneficiary, and that number is going to drop to about 2.1 in 2040, which is the year when Social Security trustees say that the trust fund is projected to be exhausted. So what does all this mean? What it means is that we in the U.S. need to undertake reforms, and undertake reforms urgently, to get, particularly Social Security, but overall the retirement system back on a stable footing. So what do we have to do? First, we've got to have major structural changes in Social Security, Medicare, and Medicaid. These programs are the bedrock for everybody, and they've got to be put on a much more stable footing. The second thing is for those who can save more, particularly middle income and above, we all need to start to save more in society. There were periods when I was at the Fed when the national savings rate as measured by national income statistics turned negative, which is to say there was dis-savings, clearly unsustainable. The crisis has forced many people back to in a savings mode as we've done what's called deleveraging, but there's more to be done in the savings arena. And the third, and this is relevant to all of us, particularly to the younger people in the audience, is many of us are going to have to extend our working lives and delay retirement beyond what we may have planned. And we clearly need to take action sooner rather than later. The longer this goes on, the greater our legacy liabilities will be as a society, and those will be liabilities that frankly have passed from my generation to your generation. The longer we wait, the larger the tax increases are going to have to be that we're going to support Social Security, which means all of you paying higher taxes. And for all those of us my age who are closer to retirement, the longer we wait, probably the deeper the cuts will have to be in benefits. And so it's really important that we move on these issues sooner rather than later. A second topic that we at the Academy looked at was financial literacy, which has become even more critical of late. And why is financial literacy important in this regard? Financial literacy is important because folks who are not financially literate have a much tougher time preparing themselves for a financially secure retirement in the uncertain environment that all of us face. And we know that far too few Americans have the financial skills to take the responsibility for savings and investments. Research by two professors who are fellows at the TIAA-CREF Institute has shown just how unprepared many Americans are. In their study of people over 50, Anna Maria Lusardi and Olivia Mitchell. Anna Maria teaches at George Washington now. Olivia is at Penn. They found that only 1/3 of respondents were able to answer correctly three basic questions that I am now going to give to you, because this is a school, and so I'm going to give you a test. You'll all pass, I promise, so don't get too anxious. And I'm not going to ask you to raise your hands. This is going to be self-graded. What do you think about that, right? The best kinds of tests, self-graded, no curve, everyone passes. So what are the questions? First, suppose you had $100 in a savings account and the interest was 2% per year. After 5 years, how much do you think you would have in the account if you let the money grow? And it's a multiple choice. First, more than $102. Now remember, its interest rate is 2% per year, 5 years. Second, exactly $102. Or third, less than $102. I'm not going to ask you to raise your hands. The correct answer, obviously, is A, including more than $102. Second question, imagine that the interest rate on your savings account is 1% per year and inflation is 2% per year. So interest 1%, inflation 2%. After 1 year, how much would you be able to buy with the money in your account? More than today, exactly the same as today, or less than today? The obvious answer is C, less than today, because this is an answer, a question around purchasing power and inflation eroding purchasing power. Third question, simple true, false. Buying a single company stock usually provides a safer return than a stock mutual fund. The answer obviously is false. This is a question obviously around diversification. So I know all of you got all three right. I'm not worried about that. The sad news is that only 1/3 of respondents got all of these right. So it gives you a sense for the average American what the very, very low level of financial literacy is. In our own recent survey, my company's institute, TIAA-CREF, surveyed or a population of Americans. We found that nearly half of them didn't know how to use the basic retirement tool of the IRA. And so this issue of financial literacy is a bedrock issue for us. And why is that the case? It won't surprise you when I say that people who have a higher degree of financial literacy are much more likely to plan for retirement. And in turn, people who plan for retirement are much more likely to do well. In fact, planning is perhaps the single largest predictor of wealth accumulation. People who plan for retirement have more than double the wealth of those versus those who do not plan for retirement. Conversely, people with a lower degree of financial literacy tend to borrow more, they tend to accumulate less wealth, they tend to select mutual funds with higher fees, they're less likely to diversify and invest in stock, they're more likely to experience some difficulty with debt, and they're less likely to know the terms of mortgages and other loans. This issue around financial literacy, by the way, is magnified if we look at different demographic groups. Minorities have some of the lowest financial literacy rates in the country. When it comes to saving for retirement, studies have found that there's serious gaps in preparedness between African Americans and Hispanics versus whites. The overall problem, I'm afraid, is likely to become even worse because we see that the degree of financial literacy training in schools is very, very low. There's a group called the Jumpstart Coalition that recently did a survey, and they found that among high school seniors, financial literacy has fallen to the lowest level it's ever been. We shouldn't be surprised by that finding, by the way, because only half the states require any form of financial literacy in their K-12 education. And so, obviously, a great deal more has to be done in this area of financial literacy. The other point I'd make about financial literacy, I've talked about one demographic group, which is minorities. Financial literacy is also incredibly important when it comes to gender differences. Women will not surprise you, or maybe you don't know this, I'm not really sure, but women tend to end up with a retirement nest egg that's half that of men of the same age and occupation. This is a reflection of three things that differentiate men from women when it comes to financial matters. First, women still earn only about 77 to 81 cents for every dollar that a man earns. Secondly, women often spend 10 to 12 years out of the active workforce, working at home, taking care of children or aging parents. Women also tend to live longer, and so they have to support themselves with a much smaller nest egg. An example of that actually here on this campus, there are about 10 oldest annuitants here. All of them are over 90 years old. Out of the 10 of them, 9 of them are women. So this longevity difference between men and women really comes to life for us here at Carnegie Mellon. For both sexes and all groups, the bottom line remains, which is how do you really ensure that folks whose primary savings vehicles are 401k savings or others can convert those savings into an adequate lifetime income. And this is a challenge not just for those of us in financial services, but it's also a challenge for policymakers and the financial services sector and individuals as well. So what is it that we in the financial services sector can do? I think the most important thing, believe it or not, is to start the process of rebuilding trust in financial services. We can't expect people to save to prepare for retirement if they don't have a high degree of trust and confidence in financial services. And it will not surprise you that for the 4th year in a row, one of the least trusted industries in America, in fact in the world, is financial services. In fact, we have placed, financial services is placed dead last in an Edelman global ranking of trust that was done recently. So what can we do to talk about how we can rebuild trust in financial services? I'll spend a few minutes on this and then turn quickly to answering questions. So first point to talk about is that rebuilding trust in financial services is not going to happen overnight. My friend Mark Carney, who is now the governor of the Bank of England, quote, said, quote, "Trust arrives on foot, but it leaves in a Ferrari." So there clearly can't be a quick fix to the trust issue that we're confronting. Nevertheless, it's important that we rebuild trust in financial services because our industry, financial services, is simply too important to our economy to be anything other than central to people's lives. Robert Shiller, the Yale professor who recently won a Nobel Prize in economics, argues that finance is one of the most powerful tools that we have for solving common problems and increasing society's well-being. He wrote a famous book called Finance and the Good Society, and he says, finance is really not about making money per se, and here I quote, finance is really creating the architecture for reaching your goal, and the goal that is served by finance are the goals that originate with each one of us. So what are some of the things that we think we can do to rebuild trust in financial services? I think it goes to something relatively simple, and it's really the flip side of what you see in the headlines every day. I think it's actually improving corporate governance in the financial services sector that's really very, very important to us. And there are a number of things that I think that we can and should do in financial services that we actually already model at TIAA-CREF. One is I think boards and management clearly have to take a longer-term view of their mission and their role and think very strongly about long-term value creation in the interest of all shareholders. And the emphasis there is going to be on long-term to avoid incenting short-term behaviors. Models have to start at the top, if you will, modeling good behavior, which is to say senior management has to really believe in the long-term goals and objectives of the business. And here you have folks in this room who are experts at this. Senior management in financial services, I think, has got to put the right kind of focus in on risk management, creating a risk management culture, creating a culture of accountability, creating a culture of compliance. I think the third thing that's going to have to happen to turn the corner with respect to financial services and trust in that space is that regulators are also going to have to take a broader view of their roles and really start to understand strategy, people, and the culture of the firms that they oversee. When I think about the mistakes that have occurred that have been headline news in financial services, an awful lot of it has to do with culture of risk-taking, culture of short-termism. Regulators have to understand that they need to have a view about that and warn management and warn boards when they see issues regarding that, developing in that regard. And finally, something that's very important to us, long-term shareholders. And my company invests, as you heard, about $596, almost $600 billion of assets for others. shareholders have to take a long-term perspective. Shareholders have to recognize that we're in it with management. When stock prices go up, we get the benefit, but when they go down, we are the victims of that. And so we have, as shareholders, to take a long-term perspective as well. And let me close by what all this means for all of you. You are here at Carnegie Mellon, the Tepper School, great institutions. You're obviously going to be leaders as you step out from this great school. And I would encourage you to do three things, and then with this, I will stop. One, I've already talked about the need to build your own financial literacy. An obvious statement, you are doing that already, and so I'm not in any sense concerned about that. Secondly, given what I've just said about the retirement crisis, as an aging baby boomer, I plead with you to save as much as possible because I'm going to need your savings. And the third thing, obviously, many of you are training to go into areas that will touch finance for sure. So I encourage you as you do that to hold on to your values, think about long-term goals and objectives, think about risk management, think about a reasonable culture that you're going to build. And so let me stop by saying, just a reminder of all the things that I've talked about today. First, I talked about the retirement crisis. I talked a bit about the aging baby boomer population. I've talked about the global impact of aging. And then finally, I mentioned that this is going to be very important for all of us to turn our attention to rebuilding trust in the financial services sector by improving the quality and elements of corporate governance with a clear focus from boards, management, shareholders on long-term issues focused on risk management and thinking about building the right kinds of cultures. So with that, let me stop. Let me thank you for your attention. I can see that most of you have now finished your lunch, so let's now turn and hopefully there'll be some questions that I can answer. So thank you very much. Hope there are a few questions, comments. I know it's right after lunch, and I don't know if at Tepper if you use the Socratic method, but I went to Harvard Law School, and one of the things I learned at Harvard Law School is it's okay to go into the audience and ask for questions if there aren't any. So just a simple, word to the wise. Please, don't be shy. Yep, please step to the mic. Take a moment to introduce yourself.
Hi, my name is Sophie Eustace. I'm a second-year MBA student.
Good.
Thank you very much for coming today. Really great to hear your talk. I was wondering if you could talk a little bit about the role of rising income inequality in this crisis.
Right. So this is a topic that's very much in the paper, obviously, and every report is that the president intends to talk about something like this. As I think about it, the issues of rising income inequality in the crisis, I would broaden it a little bit. So let me start with a couple of things that we do know. First, this crisis had a detrimental impact across every income group, but the ones that have recovered most quickly have been, frankly, folks like me, your faculty, and someday you, which is sort of upper income individuals, have recovered most quickly from this crisis. That's because the tools that have been used, and I think they were the right tools, have played through increasing equity or asset values in general. Mainly stock prices, which have gone up quite dramatically, but also home prices. And so while the crisis hit many classes of individuals, the recovery has been more skewed toward those who have assets that could appreciate in value. The second point I would make, though, is that this issue around income inequality has been one that's been growing for a long time. So the crisis and the recovery simply exacerbated something that had been a long-standing problem in America. And economists are still struggling with exactly what it is that has caused, if you will, a shrinking in the middle class, a bigger divergence in income between the relatively wealthy and everyone else. And much of it seems to go back to issues around jobs, job creation, and importantly, education. So one of the things that we've seen that plays through all of this is that there's what's called a big premium for education. Those of us, such as you, who are fortunate enough to get into a great school like Carnegie Mellon, to stay for an MBA, are much more likely to have full-time employment. and are obviously by definition much more likely to have very nice incomes. One of the things that we saw in the crisis, for example, is that individuals that have a college education or better had an unemployment rate that went up to merely about 5 to 6%. Those who did not finish high school had unemployment rates that went up well over 20%. So that's just one very stark example of something that had been going on for a long time, which is the premium placed on education. The second thing that seems to be driving some of the differences in income and, if you will, the shrinking middle class and difficulty to get into the middle class has been changes in the labor market and the interaction between technology and globalization and the creation of certain kinds of, particularly manufacturing jobs in the U.S. So jobs that in the 50s and 60s had been a big stepping stone into the middle class that may not have required higher education, that were manufacturing jobs. Many of those obviously are jobs that can be done other places. But it's not just manufacturing. Something else that's emerged is there are a lot of lower skilled white collar jobs that also have been impacted by globalization and technology. In hospitals, for example, radiologists reading CAT scans, et cetera, something that now has been done overseas. In the service sector, obviously call centers, word processing, even research is now being done overseas and then communicated back into the U.S. or other places using media that did not exist before. So what are some of the solutions? The President, I'm sure, I assume, or I've read, is going to talk about some of this today. I think most economists would say the bedrock solution has got to be driven around education, for sure. The kind of education all of you are receiving. But one of the other things that economists have discovered, and folks who are specialists in this, it's also very much around early childhood education. That seems to matter. So in some sense, that's both good and bad news, right? Because it's one thing for me to stand here and say, gee, economists tend to think that education is a good way to close some of this income disparity. Everyone knows that that's a very, very long-term solution, and particularly when it comes to early childhood education, one of the areas that's most complicated. So, those are some of the thoughts that we have on it. I gather we'll hear more tonight. I suspect there'll be a great deal of political debate around this, and so we'll see what emerges. Thanks for the question. Hope there are a few more. Yes, ma'am, please.
Thank you for coming today. My name is Michelle, and I'm also a second-year MBA student. One of the big things that's happened in the financial industry since about 2006 is dramatic consolidation, particularly too big to fail. Could you talk a bit about your thoughts on that and if there are steps to try to get more diversity back into the financial system?
Right. So one of the things that was not mentioned was when I was vice chair of the Fed, I led a study on consolidation of the financial sector. And so what do we know about it? The answer is we know quite a bit, but probably in some sense not enough. So what are the causes of this? One, I think, again, there's been technology that's been driving it. So financial services has always been a heavily technology-dependent industry, became more so with the internet, ATMs, et cetera. Technology tends to be something that's done at scale, and so that's been an important part of it. The second thing that's driven some of the consolidation in the U.S. is various financial crises, Latin America, the real estate crisis, the crisis in the oil patch from many, many years ago, created some weaknesses, some weak institutions that were then taken over by stronger institutions. So the usual kinds of things that Joseph Schumpeter would talk about in terms of creative destruction, et cetera, has led to a consolidation. The third, frankly, is in some cases relatively cheap capital allowed industries, some industry participants to consolidate, and we had 2 or 3 very aggressive CEOs who were on a track towards consolidation. So there are a number of things that drove it. One of the things that is ironic, though, is economists, as much as they look, cannot find real economies of scale in banking or financial services overall. And so the thing that would drive me as an economist to think about this as economies of scale, X the technology story, doesn't really seem to be true. So you have to look to other forces that I've just outlined. So that's sort of what drives it. And the reason that's important to understand that is I wouldn't describe any of this as necessarily nefarious behaviors. It is just simply the action of capitalism. Having said that, the government clearly took note of this and many, many years ago put in caps on the percentage of deposits in the country that could be controlled by any institution. I think there was the Regal bill, Neil Regal bill, I think did that. I used to know exactly, I've forgotten. But there's a 10% cap on the deposits that any, was a 10% cap, I think it still exists, on deposits that any institution can control. A third thing that's, another thing that's led to this consolidation, by the way, is we've seen a smaller and smaller number of banks being opened every year. So last year was the smallest number of de novo banks, I think, in the history of the country. So you have the consolidation at the top that I've talked about, capped by this 10% deposit ratio, and then you have the fact that you don't have the competitive fringe of new institutions being open. So that has led us to a place, even after the crisis has gotten even worse, where we have a relatively small number of really large institutions. That has led people to have a concern that you've raised of institutions being too big to fail. Here, I think we are struggling with what the right answer is. And so Dodd-Frank did not attack this problem directly by breaking up institutions. They've attempted to attack it in other ways. One is by having a super regulatory oversight through the FSOC committee, as you know. That group has decided to identify a few institutions as being systemically important, and they've taken an approach of giving extra oversight to those institutions, asking for more capital, probably controlling some of their activities, forcing them out of, for example, this thing called proprietary trading, all institutions out of that, obviously, and giving sort of greater regulatory scrutiny and supervisory scrutiny. This is a very controversial solution, right? There are a bunch of folks who think that the government should have used the crisis in Dodd-Frank to break up the bigger banks. There are a bunch who think that extra capital is what's called for. I tend to be personally skeptical of having the government try to decide the exact scale and scope of institutions, go in and break them up. Because the forces that led to it seem to me to be the forces of the market. And so I'm cautiously optimistic that having capital requirements that have distinctions between average institutions and systemically important ones, I hope will work. But one of the reasons I ended with this brief talk about corporate governance is I think at the end of the day, and we saw this, let's say at JP Morgan Chase and others, so much of what happens in any of these institutions is being driven by their culture. And so a culture that puts the right focus on risk-taking, long-term perspective, doing what's right for individual clients, I might be proved to be naive in this, but I think that's the second part of the solution since we've decided not to break them up. But, the truth is only time will tell, and we'll find out. So, I think it's going to be an issue that my generation dealt with, perhaps not so successfully. So I'm going to punt it to you and let you deal with it. So time for I think we have time for one or two more. I hope there are a few more questions.
Hi, I'm Jason Blakeney. I'm a junior undergraduate at Tepper.
I'm sorry, you are a
junior undergraduate.
Junior undergraduate, okay.
I was just wondering, so you talked a lot about education being the bedrock solution. Do you see any, I guess, social responsibility that larger financial institutions should take? And specifically, is there opportunity for them to close the disparities seen among minorities in financial literacy, savings, and things like that? I think there are two or three things that the financial services sector can do to start to have an impact on some of these issues. One is one that we do ourselves. I do think that this role around financial literacy, education can be very important for financial services firms. The challenge is that it appears to be very self-serving. It doesn't have to be, but there's a risk that it could be. But I can't imagine of any group that would be better placed in terms of scale, in terms of number of employees, in terms of resources to drive some of the financial literacy that I think needs to happen in the country. I think that would be incredibly important. Secondly, is I think that we can, in the financial services sector, learn and leverage some of the tools of, let's say, behavioral economics, nudge kinds of thinking, and know some of the leaders in behavioral economics are actually on this campus to get individuals to do what's in their best interest.
So you educate them and then hopefully create the right set of incentives for them to do what is in their better interest. I do think, obviously, we need to develop products and services that are in many ways more consumer friendly. One of the things that came out of Dodd-Frank, obviously, is the Consumer Financial Protection Bureau, which is going to oversee this kind of activity. But I think it falls to the industry to do that. It's easy, relatively easy for me to say that because my company, TIAA-CREF, has long stood for being very consumer friendly. We have annuities that are second to none. Our life products are world-class and some of the leading. So I'm sure that one can run a very large, successful financial services company creating products and services that are much more consumer-friendly. And then the third or fourth thing, obviously, is just the way that we run ourselves, back to the issue around trust. Since I believe, maybe naively, that in some sense dreams are built leveraging and using financial services, getting more and more folks to trust us is important, and helping to bring people into the financial world is quite important. That deals with issues such as dealing with the unbanked, for example, which is another part of the income inequality challenge. Obviously, thinking about ways to leverage what we know about individuals' behaviors to help them make better outcomes are the kinds of things I think we could do. But there's absolutely a role that we have to play. I think the truth right now, for better or for worse, is because the degree of trust in financial services is so low, most financial services firms are, I would argue, attempting to sort of keep a relatively low profile at a point when I think, what we do is much more called for, and it would behoove all of us for financial services to get itself out of the doghouse and get back to a place where it can help solve problems, because I think we actually have the ability to do that as much as anybody. One of the other points I'd make is the reason this is very important is individuals touch their financial services firms, particularly their banks, almost on a daily basis. Most of you probably don't go into a bank anymore if you're like my children of your age. But the ability to use mobile technology to check in is something that folks do actually almost on a daily basis. And so the interaction between individuals and financial services companies is actually quite regular. It's not intense in the sense of taking long periods of time, but quite regular. And I think we therefore have to leverage that regular interaction to try to make things a little better for individuals in the ways I've just described. Is that okay? Does that make sense? I thought I saw another hand. Yes, step up to the mic, please, sir.
Hi, I'm Dennis. I'm a first-year public policy student.
Great.
And, just from my understanding and experience in securities, the general focus on the long-term focus in that industry is 3 months.
Yeah.
So long-term is 3 months, and that's mainly
Right.
due to quarterly reporting standards.
Right.
So how do you get them to change? How do you
Right.
define long-term, and how do you get them to change that?
Right. Look, there's no question. One of the great joys of my company is we're not a publicly traded company, and so I don't have to go out and report earnings per share growth on a quarter-to-quarter basis, which gives us a huge luxury to take this long-term perspective. So let me sort of validate your question. One of the big challenges in the world of finance, securities, et cetera, is this hungering that we all have for earnings per share growth every quarter. I think there are a couple of ways that this can be handled, and some companies are doing this. First, I think it's very helpful for management of companies to try to step back a bit from the brink of earnings per share growth every quarter. I've seen a couple of companies where, for example, they stopped giving earnings guidance and start to talk much more about execution of strategy. And so, if management starts to do that, and it has to start with the boards of organizations, not just financial services companies in general, I think have to get used to not grading everything on an earnings per share growth every quarter, but think about success in the strategy and how you measure that over many, many years. The second way I think this could be helpful is for investors, including mutual funds in particular, to also move away from this big excitement about earnings per share growth and think about themselves as being long-term investors. That's easy for me to say because that's what we do. If I were running just a regular average mutual fund, getting people to think through why they're investing and are they investing for the long term is a lot harder to do. But I think there is a role for mutual funds to play in particular about educating mutual fund investors on the difference between speculating and investing and understanding strategy and understanding why one wants to own a stock. The thing I find ironic in that space is some of the best mutual fund managers, these are probably names that you wouldn't know, but folks of my generation, a guy named Peter Lynch who ran a very successful fund, or the folks who, such as my company, who do index funds, all take a sort of long-term perspective. And these are some of the folks who are revered as the best investors. My own company, for example, has 56 to 60% of our mutual funds rating Morningstar 4 or 5. I think that's the correct number, because we take a very, very long-term perspective. People don't tend to associate long-term investing with superb performance, so it's up to mutual fund managers such as my own company and others to sort of talk about the link between long-term perspectives and really good performance. And then the final thing, so I've talked about what companies can do, I talk about what professional investors can do. The third thing is folks like you, back to financial literacy. Understanding that earnings per share growth every quarter may not be consistent with really good long-term performance. Understanding that if you're going to really succeed as an investor, you have to know something about the company you're in, you have to understand their strategy, and you have to be able to observe how it's being executed. So, the third component of this is the individuals who are providing their money to create the capital for investments is pivotal to getting people, the earnings per share growth mindset changed. So, 3 different things that can be done. Some of them are being done. There are some good role models, such as my own company and others out there. But at the end of the day, so much of it depends on individual investors changing their behavior as well, which is why this financial literacy is an important theme for me and I think for the country. Do you have time for maybe 1 or 2 more? 1 more? There's
So a very tangible example that you gave was, I think, the fact that before we would have, or currently we have 3.3 workers supporting a retired person.
Right.
And it might drop down to
2.1, right.
So how realistic is it to, basically how aggressive is goal setting currently by policymakers? Is it attainable to ever attain that rate again in the future? Or are we looking at something far below that? And so I'm just saying, what's realistic? What's the current expectation?
All right, so look, it's going to be very hard to change that number because it reflects both aging baby boomers and declining fertility. I didn't talk very much about it, but at the height of the baby boom population, there were 3.6 births, I think it is, per woman, something like that. A few years ago, it was down to about 2.1. For those of you who are demographers, 2 is what one needs to have as a fertility rate in order just to maintain a stable population, okay? So we're not going to change the demographics of fertility very quickly in the country. What can we change? A couple of things. One is we can change how long people stay in the workforce. And so, all of us aging baby boomers can and probably should work a little longer. The second thing that we have to think about is the productivity of everyone in the workforce, so that the 3.3 going down to 2.1 still generates enough wealth in society overall to do the kind of wealth transfer that's implied in Social Security. And then the third thing that can be changed, and this is going to be a tough discussion, already has been, is how we adjust benefits, for example. There are a couple of ways we can do that will make it sustainable. One is we can actually continue to increase relatively gradually the age at which one is fully qualified for Social Security. The last time we did that, that had a very positive impact on the, described as the health of the trust fund. So there are some policy tools that we can make as individuals in terms of working longer. There are some policy decisions that truly belong to policymakers, such as adjusting the way Social Security works. And then there's this bigger, broader macro question which is continuing to increase productivity in society so that the 2.1 workers, as opposed to the 3.3, can in fact provide enough wealth in the sense of GDP to support a larger population of older people. The first one, individual choice, clearly belongs to individuals. Second one, tough as nails to try to figure out how we modify Social Security in a way that everyone across the spectrum of left to right can tolerate and accept. The third one is the most difficult, though, which is increasing productivity, which is actually one of the reasons I love being at Carnegie Mellon, because all of the increases, many of the increases that we've seen in productivity in American society have had to do with things that you folks are very close to here on this campus. Technology, organizational design, that sort of thing. And so I will stop by saying, not only do we need your savings, but we need your brain power so that us aging baby boomers can have a wonderful retirement at your expense. So thank you all very much for your attention.
I want to thank Roger for visiting Carnegie Mellon today and sharing his talk with us on some very important and informative issues that all of us deal with each and every day. So thank you for that. And by the way, I'm happy to report I got all 3 questions right. Thank you. So with that, please join me in thanking
Thank you very much. I'm not at all surprised. I would have been worried. Thank you all very much.